Well, the good news is rate relief might happen a bit sooner than expected, especially after the latest inflation figures came out. Markets are now betting there's a 77% chance of a rate cut next month, something that was viewed as pretty unlikely only just a few weeks ago. And failing that, the Reserve Bank is expected to cut by April, May, then November, so that's 3 times in total. Now, market pricing does bounce around quite a bit, so please take it with a grain of salt. But when there's a real prospect of borrowing costs coming down, you can certainly bet house prices will stay high. As for those inflation figures I mentioned, core inflation is the one the RBA cares most about, as it ignores the effect of government subsidies, which are temporarily bringing down power prices. Now, that measure of inflation is almost within the bank's target range of 2 to 3%. And while 13 rate hikes have left many of us feeling poorer and buying fewer goods, services inflation, at 4.2%, has barely budged over the past year. And the services which are seeing the biggest price increases are the ones that are hardest to opt out of, like insurance, Netflix subscriptions arguably, rent, education and even haircuts. Now, looking at the market reaction, the ASX rose by a pretty solid 0.8% to its highest level in a month. Today's best performers were gold stocks, while tech companies were the worst. And that came after heavy losses on Wall Street and Asian markets, driven by a sharp fall in Nvidia's share price. Now, the price of gold and iron ore slipped while oil rose slightly, and the Aussie dollar is languishing at around 62.3 US cents. And that's finance.